USDC and USDT Tether, top two stablecoins in terms of market cap value. What is stablecoin, how it all works, and why did these two coins conquer the stablecoin market? These and many other questions will be answered by the end of this video. And if all of this sounds confusing, don't worry, because every video on Bitcoin Academy is 100% beginner friendly. We will start this video by explaining USDT Tether, as it is the #1 most used stablecoin today within 9 key topics. Starting with very first one, which will explain what is Tether. Imagine you're holding a dollar bill. You know it's worth $1 no matter what happens to the economy or the crypto market. Now picture having that same stability, but in digital form. That's what Tether, also known as USDT, aims to be. It's a cryptocurrency designed to always have the same value as $1, making it what we call a stable coin. Tether was created in 2014 by a company called Tether Limited. The goal was simple: combine the benefits of cryptocurrency, like fast transactions and global accessibility, with the stability of traditional money. In the world of crypto, where prices can jump or crash within minutes, USDT acts like an anchor, keeping its value steady. But why does stability matter so much? Imagine you're a trader who just made some profit from Bitcoin. You could cash out to your bank account, but that takes time, fees, and sometimes complications. Instead, you can convert your Bitcoin to USDT, which stays stable, and then use it to buy more crypto when the price dips, for example, or cash out when you feel comfortable. It's like having a safe digital wallet where your money doesn't change value overnight. Another way to think about Tether is like a digital version of a savings account. You keep your funds in USDT to protect them from market swings. If Bitcoin drops 30% in a day, your USDT balance stays the same. That's why it's popular not just among traders, but also among people who want to keep their money in crypto without dealing with wild price changes or without trusting a bank. However, it's important to know that Tether itself doesn't make your money grow. Unlike Bitcoin, which people buy hoping the price will increase, USDT's job is just to stay at $1 value. It doesn't give you returns, but it doesn't drop in value either. This stability makes it a crucial part of the crypto ecosystem, especially for those who move money frequently between different digital assets. To put it simply, Tether is the bridge between the unpredictable world of cryptocurrencies and the stable world of fiat money. It's designed to keep your funds safe from volatility while allowing you to stay within the crypto space. As we move through this video, you'll see just how essential Tether has become and why it remains the #1 stablecoin by market value. And just like that, we finished topic #1. Before we move on, if you feel you are getting valuable information already, I would suggest hitting that subscribe button. Moving on to topic #2, which will explain how USDT maintains its peg to US dollar. Imagine you have a scale that always needs to balance perfectly. On one side, you have a single dollar bill, and on the other side, you have a digital token called USDT. No matter what happens, the goal is to keep both sides balanced at all times. This is essentially how Tether maintains its 1-1 peg to the US dollar. But how exactly does Tether achieve this balance? Tether Limited, the company behind USDT, claims that for every Tether token in circulation, there is an equivalent amount of assets held in reserve. This means if there are 1 billion USDT tokens out there, Tether Limited should have $1 billion or equivalent assets stored somewhere safe. In theory, this sounds simple, but in practice, it's more complex. Originally, Tether stated that each USDT was backed entirely by cash reserves. However, as the project evolved, Tether started backing its tokens with a combination of cash, cash equivalents, commercial paper, corporate bonds, and other assets. Think of it like a savings account where your balance is not just cash, but also investments and assets that can be quickly converted to cash. Here's how it works practically. When someone wants to create new Tether tokens, they send traditional currency, like US dollars, to Tether Limited. The company then issues the same amount of USDT and sends it to the user. This process is known as minting. On the flip side, when someone wants to cash out their Tether for dollars, the opposite happens. They send USDT back to Tether Limited, which burns the tokens and returns the equivalent in traditional currency. This process of minting and burning ensures that the number of Tether tokens always matches the amount of reserves. But there is a catch. Not everyone can directly exchange USDT for dollars. Typically, this privilege is reserved for large investors or institutions, while everyday users usually trade USDT on crypto exchanges. One important thing to understand is that while the system works in theory, it heavily relies on Tether Limited's transparency and honesty about its reserves. There have been controversies regarding whether all issued USDT is truly backed by equivalent reserves, which we will explore in topic number 7. But for now, just know that Tether remains the most widely used stablecoin, despite these ongoing debates. In simple terms, Tether maintains its peg by ensuring that for every USDT in circulation, there is an equivalent amount of assets held as collateral. This is what gives users confidence that one USDT will always be worth $1, no matter what happens in the volatile crypto market. And just like that, we are moving to topic number 3. And don't worry if you didn't understand something. We are just getting started. As we move on to the end of this video, everything will make sense. That's a promise. All right, topic number 3, Tether's role in the crypto market. Tether acts as a safe zone for crypto traders and investors, as we already mentioned in topic number 1. When the market is volatile, many people move their assets into USDT to protect their value. It's like stepping off a wild ride to catch your breath, knowing your money will still be worth the same when you're ready to jump back in. Unlike other cryptocurrencies like Bitcoin or Ethereum, which can lose or gain value within minutes, USDT always aims to stay equal to $1. Now imagine you're a professional crypto trader. You're constantly buying and selling various coins to make a profit. If you were to cash out to your bank every time you made a trade, you'd waste time and pay fees repeatedly. Instead, you convert your profits to USDT. This way, you can hold your gains without leaving the crypto ecosystem. It's fast, efficient, and cost-effective. Another major role Tether plays is in liquidity. Liquidity means having enough assets available to buy or sell without drastically changing the price. Crypto exchanges need liquidity to function smoothly. Since USDT is stable and widely accepted, it acts as a bridge between trading pairs. Imagine you want to trade a less popular coin that doesn't have a direct pair with Bitcoin. Instead of making multiple trades, you swap your coin for USDT, then use that USDT to buy Bitcoin. This makes trading simpler and faster. But it's not just individual traders who rely on Tether. Institutions and businesses also use it for quick settlements and as a store of value when moving large amounts of money between exchanges. If a crypto project wants to secure funds without risking a sudden drop in value, they might keep their holdings in USDT. Think of Tether like a reliable currency converter at a busy international airport. People from all over the world use it to quickly exchange money without worrying about value fluctuations. It's not just about holding value. It's about making transactions smoother and more predictable. Despite its importance, some critics argue that the dominance of Tether in the crypto market could be risky, especially if there's ever a loss of confidence in its $1 peg. Yet, because of its widespread use and integration into countless trading strategies, Tether continues to be the most traded stablecoin, handling billions of dollars in daily transactions. To sum up, Tether's role in the crypto market is crucial. It acts as a safe haven during market volatility, a bridge for trading pairs, and a liquidity provider on major exchanges. Without it, the crypto trading environment would be far less efficient and much more unpredictable. Let me congratulate you for making it this far. Now we will dive in more juicy topics, starting with number 4, which will explain how Tether is issued and redeemed. But before we dive in, let me know in the comments section how you like the video so far. Okay, getting back to topic 4. Imagine you're at a place where traditional money is printed. You hand over a specific amount of gold, and in exchange, you receive paper notes that represent that value. Tether works in a similar way, but instead of gold or cash, you're dealing with digital assets. The process of issuing Tether, also known as minting, starts when a user or institution sends traditional currency, like US dollars, to Tether Limited. In return, Tether Limited issues an equivalent amount of USDT. For example, if someone deposits $1 million, Tether Limited mints 1 million USDT and credits it to the user's account. This process ensures that the number of USDT tokens in circulation always matches the value of the reserves held by the company. But what happens when someone wants to exchange their USDT back into dollars? This is where the redemption process comes in. The user sends their USDT back to Tether Limited. The company then burns or permanently destroys the return tokens and releases the equivalent amount of dollars to the user. It's like returning your paper notes to the cash printing place and receiving the gold back. The burning process ensures that the total supply of USDT decreases as it is cashed out, keeping the system balanced. One thing to note is that not everyone can directly interact with Tether Limited to mint or redeem USDT, as we already said. Typically, this privilege is reserved for large institutional clients or significant holders. Everyday users usually exchange USDT through crypto exchanges rather than directly with the company. This is why you see a lot of Tether trading on platforms like Binance or Coinbase, for example. Now, you might wonder why the average trader doesn't directly mint or redeem USDT. The reason is simple. It requires significant amounts of money and compliance with strict verification processes. For most users, buying or selling USDT on an exchange is much faster and more practical. Let's take a simple example. Imagine you are a crypto exchange and your customers want to trade a lot of Bitcoin for USDT. You don't have enough USDT in your reserves, so you approach Tether Limited and deposit a large amount of dollars. Tether then issues new USDT, which you distribute to your customers. This way, liquidity is maintained and trading can continue smoothly. It's important to know that this minting and burning process is what keeps the peg stable. If Tether kept issuing tokens without having equivalent reserves, it would risk breaking the $1-to-$1 value. This is why transparency about reserves is crucial, even though it has been a point of controversy in the past. To put it simply, Tether is issued when dollars flow in and redeemed when dollars flow out. The balance between minting and burning ensures that each USDT is always backed by a corresponding dollar or asset of equal value. This way, users can trust that their digital dollars will always be worth one real dollar. All right, we have come to topic number 5. And believe me, after this one, you will understand more than 90% of people that are involved in crypto, because we are about to explore all blockchain networks that support Tether. Trust me, this topic is super important for your crypto education. Okay, imagine you're carrying cash, but instead of putting it all in one wallet, you spread it across several wallets to make sure it's always accessible, no matter where you go. That's how Tether operates in the crypto space, spreading its digital dollars across multiple blockchains to increase flexibility and reach. Tether was originally issued on the Bitcoin blockchain through a protocol called OmniLayer. This made Bitcoin the first home for USDT. But as the crypto world expanded and new blockchains emerged, Tether adapted to keep up. Today, you can find USDT on a wide range of blockchain networks, each offering unique advantages. Let's explore those networks. Ethereum quickly became one of the most popular networks for Tether, especially with its ability to support smart contracts and decentralized applications. And if you don't know these terms, I would suggest watching my video which explains Ethereum from scratch. After you finish this one, I will leave a link down in description. On Ethereum, Tether exists as an ERC20 token, and ERC20 is just a term for token standard on Ethereum blockchain, which is nothing more than a set of rules and functions that Ethereum-based tokens must adhere to in order to exist on its network. Don't let unknown terms scare you. This means it can be easily integrated into decentralized finance protocols and traded on decentralized exchanges. Imagine having a digital dollar that not only works for transactions, but can also be used in lending, staking, or yield farming. That's why Ethereum's version of USDT became so widely used. But as Ethereum faced congestion and high fees, other blockchains began to emerge as faster and cheaper alternatives. One of the most prominent is Tron. On the Tron network, Tether exists as a TRC20 token. And once again, TRC20 stands for token standard. Same as ERC20, but this time on Tron network, you get the point now. And I believe I deserve that one like from you. USDT on Tron is known for ultra-low transaction fees and quick transfers, making it popular for users who need to move funds frequently without incurring hefty costs. Another notable network that supports Tether is Binance Smart Chain, or BSC. As a BA20 token on BSC, USDT benefits from faster transactions and lower fees compared to Ethereum. This makes it particularly useful on platforms where traders need quick execution without paying high transaction fees. You can also find Tether on other blockchains like Solana, Algorand, and even Layer 2 solutions like Arbitrum. The idea is simple. By existing on multiple blockchains, Tether becomes more versatile. Users can choose the network that best fits their needs, whether it's speed, cost, or integration with specific applications. This multi-network presence is crucial because it allows Tether to stay relevant, regardless of how the crypto space evolves. If one blockchain becomes too congested or expensive, users can easily switch to a more efficient network without losing access to their stable coins. To put it simply, Tether's presence on multiple blockchains makes it more resilient and accessible. It's like being able to use your money in any country without worrying about which currency they accept. This flexibility is one of the key reasons why USDT remains the most widely used stablecoin in the crypto ecosystem. And just like that, we came to topic number 6, use cases of Tether. And things are getting more spicy after we finish this one. So let's jump straight into it. We already talked about Tether's consistent value and its core purpose of being a shelter of stability in crypto space. But Tether's role goes beyond just being a shelter. It's also widely used for everyday transactions, especially in places where access to traditional banking is limited or unreliable. Imagine you're in a country where inflation is making local currency worthless. Instead of holding cash that loses value, people can use USDT to maintain purchasing power. It's a practical solution for those looking to protect their savings from economic instability. Then there's the world of crypto trading. Tether is often used as a trading pair on exchanges. Instead of trading Bitcoin directly for another volatile asset, traders use USDT as a middle ground. This makes it easier to calculate profits and losses since USDT always equals $1. Think of it as a measuring stick that doesn't change size no matter what's happening in the market. Another significant use is in DeFi, or decentralized finance. On platforms like Compound, for example, users can lend or borrow Tether just like they would with traditional currencies in a bank. Lending your USDT earns you interest, while borrowing allows you to access funds without selling your other crypto assets. It's like putting your money to work while still keeping it secure. Remittances are another practical application. Imagine working abroad and sending money back home. Traditional remittance services can charge high fees and take days to process. Using Tether, you can transfer funds almost instantly and at a fraction of the cost. It's a game changer for people supporting families in countries where banking systems are slow or expensive. Tether also plays a crucial role in cross-border business transactions. Companies that operate globally often use USDT to make payments to partners and suppliers. This way, they avoid the hassle of currency conversion and reduce the risk of exchange rate fluctuations. It's like paying in a universal currency that everyone understands and accepts. All right, now you know about Tether, more than 95% of people that are involved with crypto, but let's make that number closer to 99% by diving in controversies surrounding USDT. Imagine you're at a grand casino where everyone is betting big, and the chips seem endless. But suddenly, someone questions whether the casino actually has enough cash to back all the chips in play. That's the kind of suspicion that has surrounded Tether for years. Despite being the most widely used stablecoin, Tether has faced significant controversy, mainly around one issue: its reserves. The most critical question is whether Tether Limited actually holds enough assets to back every USDT in circulation. Originally, Tether claimed that each USDT was fully backed by a dollar held in reserve. This meant that no matter how many USDT tokens existed, there would always be an equivalent amount of dollars safely stored. But over time, that story became more complicated. In 2019, Tether Limited revealed that not all USDT tokens were backed purely by cash. Instead, the reserves also included commercial paper, loans, and other assets. Imagine thinking your savings are all in cash, only to find out they're partially tied up in corporate IOUs and other investments. This revelation shook the crypto community and raised doubts about whether Tether could truly guarantee its one-to-one peg during a financial crisis. Things escalated when regulators stepped in. In 2021, Tether and its sister company Bitfinex reached a settlement with the New York Attorney General. The allegations were serious. Tether had allegedly misrepresented the reserves backing its stable coins. As part of the settlement, Tether agreed to pay an $18.5 million fine and provide regular reports about its reserves. While Tether did not admit wrongdoing, the case fueled ongoing skepticism. Another point of criticism is how Tether is used within the crypto ecosystem. Because USDT is so widely traded, some speculate that it might be used to artificially inflate the price of other cryptocurrencies. Think of it like a market where counterfeit chips are being used to boost the value of the game. If Tether's reserves don't truly back the tokens, this could have serious consequences for the entire crypto market, creating unnatural inflation that can disrupt everything. Adding to the controversy, Tether's auditing practices have been a constant point of debate. Instead of undergoing a full, independent audit, Tether Limited has released what they call attestation reports. These documents provide snapshots of their reserves at specific points in time, rather than a continuous, comprehensive audit. Critics argue that without a thorough and ongoing audit from a reputable third party, it's impossible to be completely sure that every USDT is backed as promised. Regulatory pressure remains a looming threat. Governments around the world are increasingly scrutinizing stablecoins, and Tether is often at the center of the conversation. Some regulators worry that a sudden loss of confidence in Tether could trigger a massive sell-off, not just in USDT, but across the entire crypto market. This fear stems from Tether's enormous daily trading volume and its integration into many trading pairs on major exchanges. Despite these controversies, Tether continues to be the most traded stablecoin, processing billions of dollars in transactions every day. Supporters argue that Tether's utility and longevity prove its reliability, while critics insist that the lack of transparency leaves too many unanswered questions. All right, we are almost at the finish line. Topic number 8 will explain risks and limitations of using USDT. One of the primary risks with Tether is its reliance on maintaining a 1-1 peg to the US dollar. As we discussed earlier, this peg is based on the reserves held by Tether Limited. If those reserves are ever questioned or proven insufficient, the value of USDT could quickly drop. Imagine holding a dollar bill that suddenly loses half its value because the bank backing it ran out of money. That's the kind of risk that makes some investors nervous. Another major risk is regulatory pressure. Governments and financial authorities around the world are increasingly scrutinizing stablecoins, with Tether often in the spotlight. Some regulators argue that stablecoins could pose a systemic risk to the financial system if they're not properly backed. If tighter regulations were enforced, Tether might face restrictions, fines, or even bans in certain jurisdictions. Imagine a popular restaurant suddenly facing health inspections that could shut it down overnight. That's how regulatory threats hang over Tether. There's also the issue of liquidity risk. While Tether is highly liquid on most major exchanges, there's no guarantee that this will always be the case. If a major exchange were to delist USDT or a large number of users lost confidence, liquidity could dry up quickly. In such a scenario, selling large amounts of Tether without significant price slippage might become difficult. Another challenge is blockchain compatibility. While Tether is available on multiple blockchains, each network has its own risks and costs. For instance, using USDT on Ethereum can lead to high transaction fees during network congestion. On the other hand, faster networks like Tron might face centralization concerns. This variability can impact how easily you move your USDT between platforms, potentially locking you into a network where costs suddenly spike. Market sentiment is another unpredictable factor. Even a rumor about Tether losing its peg can cause a sudden rush to sell, leading to temporary price dips. These scares have happened in the past, where USDT briefly traded below $1 during panic sell-offs. Although it recovered quickly, the mere possibility of losing value contradicts the core idea of being a stable coin. Lastly, using Tether in decentralized finance also carries its own risks. Since DeFi protocols are built on smart contracts, bugs or exploits could potentially affect your funds, including USDT held within these platforms. If a lending protocol gets hacked, your Tether stored within it could be lost, even if Tether itself remains stable. To sum up, while Tether is widely used and highly convenient, it's not without risks. The biggest concerns revolve around maintaining the 1-1 peg, the lack of full audits, regulatory challenges, liquidity risks, and vulnerabilities within DeFi applications. And now you understand why educating yourself is the #1 most important thing in world of cryptocurrencies. The more you know, the better action you can generate to keep your funds safe. And our final topic for today is discussing potential future of USDT. Tether has maintained its position as the top stablecoin for years, but staying there will require adapting to new challenges. One of the biggest factors shaping its future is regulation. Governments around the world are increasingly focusing on stablecoins. As regulators push for more transparency and tighter control, Tether will need to adapt its practices, particularly regarding how it reports its reserves. Another critical factor is competition. More stablecoins are entering the market, and some are gaining ground by offering greater transparency or more advanced features. For example, USDC and BUSD are becoming popular among users who value regulated and audited stablecoins. If Tether doesn't address its own transparency issues, it might lose market share to these newer, more transparent options. Then there's the matter of blockchain evolution. As new and faster blockchains emerge, Tether will need to maintain its multi-network presence to stay relevant. Imagine a bus service that must constantly update its routes to keep up with a city's growth. If Tether fails to integrate with popular new networks, users might migrate to other stable coins that are more versatile. Another area of growth could be the increasing integration of Tether into traditional finance. Some financial institutions are exploring how stablecoins can be used for instant settlements and cross-border payments. If Tether successfully navigates regulatory hurdles, it could become more than just a crypto trading tool, evolving into a mainstream financial instrument. However, this would require stronger regulatory compliance and partnerships with traditional banks, which might fundamentally change how Tether operates. Furthermore, Tether's role in decentralized finance could expand. As DeFi matures, stablecoins will continue to be essential as collateral for loans and liquidity in automated market makers. However, Tether will need to ensure that its integration into DeFi remains secure, as vulnerabilities in DeFi platforms could indirectly affect Tether's reputation. Finally, the rise of central bank digital currencies, or CBDCs, could also impact Tether. If governments start issuing their own digital dollars or euros, Tether could face competition from official government-backed stablecoins. The key will be maintaining Tether's unique advantage of being blockchain agnostic and globally accessible, while also addressing the security and transparency concerns that CBDCs naturally sidestep. To put it simply, the future of Tether is about balancing between regulatory compliance, maintaining user trust, staying competitive, and expanding its use cases. If Tether manages to address its long-standing controversies and adapt to new market demands, it could remain the dominant stablecoin. But the road ahead is filled with challenges, and how Tether navigates these will determine whether it continues to thrive or gets overtaken by emerging alternatives. Let me congratulate you for making it this far through the video. You already know so much. But in order to make decision on which one is better, we must head on and explain USDC. And trust me, after you finish the video, you will have more than enough information on which one is better for you. All right, we will divide USDC in 9 key topics, starting with very first one, which will briefly explain what is USDC. Imagine you're holding a dollar bill. You know it's worth $1, no matter what happens in the economy. Now picture having that same stability in digital form. That's what USDC, or USD Coin, represents. It's a type of cryptocurrency known as a stable coin, designed to maintain a value equal to $1 at all times. In the world of cryptocurrencies, prices can fluctuate wildly. For instance, Bitcoin and Ethereum can rise or fall significantly within hours. This volatility can be challenging for those who want to use digital currencies for everyday transactions or savings. USDC addresses this issue by providing a stable digital asset that mirrors the value of the US dollar. So, why does this matter? Let's say you're a trader who just made a profit from Bitcoin. You could convert your earnings into USDC to protect your gains from market swings. Later, when the market dips, you can use your USDC to buy more crypto. It's like having a safe digital wallet where your money doesn't change value overnight. But USDC isn't just for traders. It's also used for everyday transactions, especially in regions where local currencies are unstable. People can use USDC to send money across borders, make purchases, or even save, all without the need for traditional banks. Its stability and reliability have made it a popular choice for many looking to navigate the digital economy safely. In essence, USDC bridges the gap between traditional finance and the digital world. It offers the benefits of cryptocurrency, like fast transactions and global reach, while maintaining the trust and stability of the US dollar. As we continue, you'll see how USDC plays a crucial role in the broader financial ecosystem. And just like that, in a matter of few minutes, you already know what USDC is. And if you like the value you're getting, please make sure to like and subscribe, and I promise you won't regret it by the end of today's video. All right, let's dive in topic number 2, which will explain who created USDC. To understand who created USDC, we need to look at the collaboration between 2 significant players in the cryptocurrency industry. In 2018, 2 companies came together to launch USDC, Circle and Coinbase. Circle, a financial technology firm, and Coinbase, a leading cryptocurrency exchange, co-founded the Center Consortium. This consortium was responsible for the development and governance of USDC. Circle was established in 2013 by Jeremy Allaire and Sean Neville. The company's mission has been to create a more open and inclusive global financial system through the use of blockchain technology. Coinbase, founded in 2012 by Brian Armstrong and Fred Ehrsam, has grown to become one of the largest cryptocurrency exchanges in the United States. The partnership between Circle and Coinbase aimed to combine their strengths to create a stable and transparent digital dollar. USDC was designed to be a fully collateralized stable coin, meaning each USDC token is backed by $1 held in reserve. This structure was intended to provide users with a reliable and secure digital currency that maintains a stable value. And don't worry, we will fully explain how this stability is kept in topic number 4. In 2023, the Center Consortium was dissolved, and Circle assumed sole governance and issuance responsibilities for USDC. This move was part of an effort to streamline operations and enhance accountability. Despite this change, Coinbase continues to play a significant role in the USDC ecosystem, including holding an equity stake in Circle and sharing in the revenue generated from USDC reserves. The collaboration between Circle and Coinbase in creating USDC represents a significant step in bridging traditional finance and the emerging digital economy. Their combined efforts have contributed to the widespread adoption and trust in USDC as a stable digital currency. Before we move on, we must say that USDC is a cryptocurrency. And what better way to explain that than by comparing it to Bitcoin and Ethereum? Imagine you are standing in a market where prices of everything around you keep jumping every few seconds. That is what Bitcoin and Ethereum feel like. One day you have enough to buy a new phone. Next day your money is down by 20%. And while this volatility is what gives people the chance to make profits, it is also what makes these coins risky for saving or spending in day-to-day life. Bitcoin is often called digital gold. It is limited in supply and it is decentralized, which means nobody controls it. Its value is mostly based on what people are willing to pay for it. That is why it moves up and down so much. Ethereum is a bit different. It is not just a coin, it is a full platform where developers build smart contracts and apps. But its price also moves constantly, sometimes even more than Bitcoin. Now picture a coin that does not jump in value at all. That is USDC. Its job is not to grow or shrink. Its job is to stay equal to $1 at all times. It does not try to be digital gold or a platform for apps. It simply offers digital dollars that you can use anytime without worrying if your value will change tomorrow. You can think of Bitcoin and Ethereum as wild horses. They are powerful and fast, but hard to control. USDC is more like a reliable train that always arrives on time. You do not use it for a thrill. You use it when you want safety and predictability. Before we move on, if you want to learn about Bitcoin or Ethereum, make sure to check simple explanation for both on our channel after you finish this video. I will leave a link down in description. All right, all of this sounds nice, but how does USDC keep stable value of $1? Let's explain it by diving in topic number 4. USDC or USD Coin is a type of cryptocurrency known as a stablecoin. Its primary purpose is to provide a digital equivalent of the US dollar, offering the benefits of cryptocurrency without the typical price volatility. To achieve this, USDC employs a straightforward approach. For every USDC token in circulation, there is an equivalent amount of US dollars or dollar-denominated assets held in reserve. These reserves are managed by Circle, the company behind USDC. The assets backing USDC include cash and short-term US Treasury securities, which are held in segregated accounts with regulated financial institutions. This ensures that each USDC token is fully backed by real-world assets, providing confidence to users that they can redeem their tokens for US dollars at any time. The process of maintaining this one-to-one peg involves two key operations: minting and burning. When someone wants to acquire USDC, they deposit US dollars with Circle, which then issues an equivalent amount of USDC tokens. This is known as minting. And on the other side, when someone wants to convert their USDC back into US dollars, the tokens are returned to Circle and removed from circulation. This is called burning. This system ensures that the supply of USDC always matches the amount of reserves held, maintaining its stable value. Transparency is a critical component of USDC's stability. Circle provides regular reports and undergoes monthly attestations by independent accounting firms to verify that the reserves match the amount of USDC in circulation. This level of openness helps build trust among users and distinguishes USDC from other cryptocurrencies that may lack such transparency. In fact, #1 stablecoin by market cap is facing criticism because of questionable transparency, and that is one of the reasons USDC is growing rapidly. In summary, USDC maintains its equal value to the US dollar through a combination of full reserve backing, regulated financial practices, and transparent reporting. This structure allows users to enjoy the advantages of digital currency while relying on the stability of traditional fiat money. Okay, you got the basics now, but let us dive deeper inside those reserves that actually give USDC its stable value. You already know that every single USDC token is backed by real assets, but now let us look at what those assets actually are. The reserves that support USDC are managed by Circle, and the most important part is that they are made up of two main components: cash and short-term government securities. That means when you hold one USDC token somewhere in the real world, there is either one physical dollar or an ultra-safe government-backed asset tied to it. These reserves are not just stored randomly either. They are kept in accounts with regulated financial institutions and are held separately from the money Circle uses for its own business. The majority of the reserve is placed into very short-term United States Treasury securities. These are considered one of the safest types of investments in the world. They are backed by the United States government and mature quickly, which means the money is always available and easy to access. A smaller part of the reserve is kept in cash, which sits inside top-tier banks. This combination gives Circle the ability to redeem USDC quickly if needed, while keeping the system secure and trustworthy. Now, here is something really important. These reserves are managed with full transparency. Circle works with independent accounting firms who check the numbers every single month, and they publish attestations to confirm that the amount of assets always matches or exceeds the amount of USDC in circulation. Not only that, but the fund that holds most of the reserve is managed by BlackRock, the largest asset manager in the world, which gives an extra layer of confidence. It is time to get back to crypto terminology and explore blockchains that support USDC. And the truth is, this is where USDC really stands out, because it is not tied to just one network like many other coins out there. It lives across multiple blockchains, and that makes it extremely flexible and powerful. USDC was first launched on Ethereum, which is still one of the most popular blockchains for decentralized apps. But since then, it has expanded massively. Today in 2025, USDC is supported natively on 20 different blockchain networks. That means it is not some copy or wrapped version. It is the real USDC issued directly by Circle on each of those chains. This includes networks like Solana, Avalanche, Polygon, Base, Arbitrum, and many more, including newer ones like Aptos and Sonic, which are rising fast. Each of these blockchains brings something different to the table. Some, like Ethereum, are known for their security and strong developer community. Others, like Solana, are built for speed and low fees, making them perfect for fast payments and gaming apps. Avalanche is optimized for scaling, while chains like Base and Optimism are part of a new wave of Layer 2 solutions that help Ethereum run faster and cheaper. Circle also created a system called Cross-Chain Transfer Protocol. This tool allows USDC to move smoothly from one blockchain to another. It works by burning USDC on one chain and minting it fresh on the other side. That way, you are never stuck with fake wrapped versions. You always hold the original USDC, just on the chain you want. This multi-chain approach makes USDC incredibly versatile. It gives developers more options, it gives users more freedom, and it allows the digital dollar to travel across the decentralized internet with no borders. So no matter which blockchain you like best, chances are USDC is already there, ready to be used in your wallet, your app, or your smart contract. Now let's explore a topic which everyone wants to know. Is USDC safe to use? When it comes to digital currencies, safety is a top concern. Let's explore the factors that contribute to its security and reliability. But first, let's briefly remember what we learned by now. USDC, or USD Coin, is known for its strong commitment to transparency and regulatory compliance. Issued by Circle, a regulated financial technology company, USDC is designed to maintain a stable value pegged to the US dollar. This stability is achieved through full backing by cash and short-term US government securities, ensuring that each USDC token is redeemable for $1. To reinforce trust, Circle provides regular attestations of USDC's reserves. These attestations are conducted monthly by independent accounting firms, verifying that the reserves match or exceed the amount of USDC in circulation. This level of transparency is a key differentiator for USDC, especially when compared to other stable coins that may lack such rigorous oversight. Regulatory compliance is another cornerstone of USDC's safety. Circle collaborates with regulators and adheres to financial laws in various jurisdictions, including the United States. This proactive approach to regulation helps ensure that USDC operates within legal frameworks, providing users with an added layer of security. However, it's important to acknowledge that no financial asset is without risk. For instance, in March 2023, USDC temporarily lost its peg to the US dollar due to the collapse of Silicon Valley Bank, where a portion of its reserves was held. Despite this, USDC quickly regained its peg, demonstrating resilience in the face of financial disruptions. Additionally, USDC is not entirely decentralized. Circle has the authority to freeze USDC tokens in compliance with legal requirements. While this feature enhances regulatory compliance, it may raise concerns for users who prioritize complete decentralization and autonomy in their digital assets. In summary, USDC is considered one of the safer stablecoins available, thanks to its transparent reserve practices, regular audits, and adherence to regulatory standards. While it has experienced challenges, such as the temporary depegging incident, its overall structure and governance contribute to its reputation as a reliable digital asset. All right, but as everything in this world, there are always risks. Same applies to USDC, so let's explain them in topic number 8. While USDC is designed to maintain a stable value and has established itself as a reliable stable coin, it's important to understand that it carries certain risks and limitations. One notable risk is the potential for depegging. Although USDC aims to maintain a one-to-one peg with the US dollar, extreme market conditions can cause it to deviate from this value. For instance, during the collapse of Silicon Valley Bank in March 2023, as we already mentioned in previous topic, USDC temporarily lost its peg due to a portion of its reserves being held at the bank. Although it quickly regained its peg, this incident highlighted the vulnerability of stablecoins to external financial shocks. Another consideration is the centralized nature of USDC. Circle, the issuer of USDC, has the authority to freeze tokens in compliance with legal requirements. While this feature enhances regulatory compliance, it may raise concerns because one company has high control point over it. Additionally, using USDC on third-party platforms introduces risks. Circle cannot control how third parties value USDC, and the value of USDC can fluctuate above or below $1 on these platforms. Users accept all consequences of sending USDC off of Circle's platform, including potential loss of access to their tokens. Regulatory uncertainties also pose challenges. While Circle collaborates with regulators and adheres to financial laws in various jurisdictions, the regulatory landscape for stablecoins is still evolving. Changes in regulations could impact the operations of USDC and its accessibility in certain regions. In summary, while USDC offers stability and transparency, users should be aware of its potential risks, including depegging events, centralized control, third-party platform risks, and regulatory uncertainties. Understanding these factors is crucial for making informed decisions when using USDC. Now that we've covered how USDC works and the risks involved, let's look ahead and explore what the future might hold for this digital dollar. Because understanding where USDC is going can help you see how it may continue to shape the financial world around us. USDC has already proven that it is more than just another cryptocurrency. In just a few years, it has processed over $18 trillion in transaction volume and continues to grow across both crypto and traditional financial systems. One of the biggest signals of its future strength is how it is being adopted beyond just crypto trading. More businesses, fintech apps, and even banks are beginning to explore ways to use USDC for things like payments, lending, and international transfers. That means the digital dollar is slowly finding its way into real-world finance, not just staying in crypto wallets. Regulation is another key part of USDC's future. While many stablecoins are still facing questions from governments, Circle has been working closely with regulators to stay compliant. In fact, proposed legislation in the United States, such as the Genius Act, is expected to set clearer rules for stablecoins. And Circle already meets many of those requirements, like full reserve backing and regular public attestations. This puts USDC in a strong position to grow, even as the rules around digital money become more strict. On top of that, Circle is pushing forward with innovation. They recently launched a global payments network built around USDC, aiming to help businesses move money instantly across borders without relying on slow traditional banks. This shows that the team behind USDC is not just focused on stability, but also on making the currency more useful and accessible in everyday life. Of course, the future will also come with competition and challenges. Other stablecoins, including ones issued by governments or major banks, are being developed rapidly. But USDC has a big head start and continues to expand across multiple blockchains and into new markets. As more users demand fast, transparent, and reliable digital money, USDC is likely to remain one of the most trusted options. So while nobody can predict the future perfectly, the direction is clear. USDC is not standing still. It's evolving, growing, and preparing to be a permanent bridge between the old world of finance and the new digital economy. And just like that, You made it to the very end, but stay a second longer. As you noticed, World of Crypto is growing at insane rate. And in order to make some success inside it, you need to educate as much as possible. So I would encourage you to watch one of these two videos you see on the screen right now. I truly hope you found this video helpful. If yes, make sure to leave your thoughts in comment section. Also, leave a like and subscribe. All the best, and see you in my next video.